It's a wave 4 years in the making and has reached two more of the largest US firms in a single fortnight. The deals read as equity stories, the mechanism that sustains them, and the capital that funds them sits one layer below in the debt. Dozens of the 100 largest US firms have either sold an ownership stake or have been absorbed by one that has. And this is since June of 2021. Crowe to KKR in a deal valuing it at nearly $3 billion and Eide Bailly to Reverence Capital at about $1.8 billion. Both are reported as equity stories. A sponsor takes majority control, partners monetize. The firm gets capital for technology and acquisitions. That framing is correct but not complete. The consolidation story is well understood. The financing story, which holds the cash flow risk on the business that AI is repricing, is the one that is still being written. Hello everyone, welcome back to our channel and welcome back to the Capital Insights series. This series sits within our Fundamentals Through the Noise series here at Punjab Capital Research. And today, in this video, we wanted to talk to you about private equity's accounting wave, the consolidation story, and its financing. It's a wave 4 years in the making and has reached two more of the largest US firms in a single fortnight. The deals read as equity stories, the mechanism that sustains them, and the capital that funds them sits one layer below in the debt. Private equity has spent 4 years buying its way into the accounting profession. In a single fortnight in June, two of the largest US firms outside the Big Four agreed to sell. Crowe to KKR in a deal valuing it at nearly $3 billion and Eide Bailly to Reverence Capital at about $1.8 billion. Both are reported as equity stories. A sponsor takes majority control, partners monetize. The firm gets capital for technology and acquisitions. That framing is correct but not complete. The mechanism that lets the wave continue and the channel that ultimately funds it sits one layer below the headline. This particular video maps both why the profession is being consolidated and how the consolidation is being paid for. Let's first talk about the wave. Now, by mid-2026, the question is no longer whether a large US accounting firm will take private equity capital, but which of the remaining holdouts will be the last. Dozens of the 100 largest US firms have either sold an ownership stake or have been absorbed by one that has. And this is since June of 2021. The June cluster is simply the leading edge reaching the top of the league table. Crowe ranked 12th nationally with roughly $1.4 billion in US revenue. Some 540 partners and 5,600 staff agreed on 11th June to take on investment from KKR into its newly carved out advisory entity. And 12 days later, Eide Bailly ranked 18th with some $840 million in revenue and more than 3,500 people across 50-plus offices agreed to sell a majority stake to Reverence Capital. Both the transactions are slated to close in the third quarter. They join a roster that already includes big names like Baker Tilly, Grant Thornton, and more. What remains outside is now a very short list. Clifton Lawson, Allen, and Plank Moran, the most conspicuous, and that scarcity is itself a part of the thesis. The holdouts have become the supply. Now, the pattern is not a series of one-offs, but a programmatic consolidation. Grant Thornton's private equity-backed US arm has acquired close to 20 firms within its own global network since New Mountain Capital took a stake in 2024, a template that every new sponsor is underwriting towards. Here's what Crowe CEO said on the rationale for selling, that the whole competitive landscape is transforming much faster than I probably would have predicted a few years back. And this brings us to why does private equity want it? The attraction is a cash flow asset that was until recently structurally close to outside capital. Mid-market accounting and advisory work throws off recurring contracted fee revenue against sticky multi-year client relationships in a market that is fragmented across hundreds of regional firms. The classic substrate for a buy and build. The sponsors are explicit that immediate catalyst is the technology arms race. Crowe frames the capital as a way to stay ahead in a landscape transforming faster than expected. Eide Bailly's readership cites clients navigating rising complexity across data and AI. Another important point out here is that the capital also buys acquisition firepower directly. Right through the cash flows, the stated AI rationale carries a second meaning. The economics of an accounting firm rests on labor leverage. A broad base of junior staff billing hours beneath a thin layer of partners. That pyramid is precisely what agentic automation compresses. So the same technology cited as a reason to invest is also the force of re-architecting the margin engine being bought. The buyers are paying for productivity capture, whether they are capturing it before it is completed away or financing the restructuring of a model that is quietly breaking, is the question that the valuations do not yet distinguish. Next, let's talk about the structure that is making all this possible. An accounting firm cannot simply be bought. Under the SEC and the State Accountancy Board independence rules, the audit business generally may not have outside ownership. The wave depends entirely on the workaround, the alternative practice structure. The firm splits into two. The attest business remains a licensed CPA firm, partner-owned, performing audits and reviews. The non-attest business, tax, advisory, consulting, is reconstituted as a separate entity that receives the private equity investment. Now, this is the enabling arbitrage, and it is worth stating plainly because it shapes everything downstream. The capital and the leverage attaches to the advisory entity and its fee streams, not to the regulated audit practice. The value creation thesis and the credit risk both live in the unregulated half of the firm. Next, let's talk about the consistent print. Now, what turns a sequence of deals into a repricing is the repeatability of the multiple. Crowe at roughly $3 billion on a $1.4 billion of revenue prices at close to 1.2x revenue on roughly $225 million of EBITDA reported around the deal. Now that is approximately 13x earnings. Eide Bailly at about $1.8 billion on $840 million of revenue lands essentially at the same 2.1x revenue. So essentially what we are seeing out here is that two firms, two sponsors, 12 days apart at the same headline multiple. That consistency is the signal. The market is converging on a price for mid-market professional services as an asset class, not bidding idiosyncratically for individual franchises. Next, let's also see as to how it is all being financed. Here, the equity framing gives way to more revealing structure. An accounting firm deal is paid for in three distinct layers, and they draw on three different pools of capital. The equity layer, mainly the headline out here, comes from the flagship private equity buyout funds. Committed limited partner capital sourced from pensions, endowments, and sovereign funds. KKR's Crowe stake goes to its North America Fund 14. Reverence invests through its financial services private equity strategy. This pool is largely separate from the insurance channel. KKR's own deal language carries a standard hedge that its investments may include the activities of its sponsored funds and insurance subsidiaries. But the disclosed vehicle is the drawdown PE fund and not Global Atlantic. Now, the debt layer is exactly where the channel converges. The acquisition leverage and the war chest for the subsequent roll-up of smaller firms is supplied by private credit. The Crowe transaction carried roughly $1 billion of debt that KKR shopped to direct lenders at around SOFR plus 550 basis point, with SOFR at 3.6% in late June. So that is basically an all-in cost at nearly 9%. Now, the precedent out here is the Baker-Tilly-Moss-Adams merger, wherein Blackstone led a lender group providing $1.4 billion debt package. Now, the industry pricing corroborates the level because the average private credit spread on North American financials buyouts ran at around SOFR plus 492 basis points in the first quarter, roughly 8.5% all-in. This is the sponsor-backed cash flow lending against a fee stream and not an asset-backed lending against collateral. The funding base beneath those lenders is increasingly the insurance float. US life insurers held approximately $807 billion of private credit and illiquid assets in 2025, roughly a fifth of their $4 trillion fixed income portfolios, up from $685 billion a year earlier. And the insurance-affiliated managers led the growth, with KKR's Global Atlantic and Apollo's Athene, each lifting private credit allocations by about 30%. McKinsey estimates insurance-linked platforms deployed approximately $180 billion into private credit in 2025, up from $120 billion in 2023. Now, the decisive detail out here is that these hybrid insurance fee credit vehicles target approximately 100 million to 1 billion tickets at approximately 7 to 10% blended returns. So essentially what we are trying to say out here is that this is a node in the private credit channel. The connection runs through the debt tranche and lender's funding base and not through the equity check that makes the headline. Let's wrap the video with the tension and what to watch out for. Now set the two flows side by side and the structure becomes pointed. The same insurance-funded private credit complex is at once Financing the compute build-out that automates cognitive labor, for example, data centers and chips, lent against on a hard depreciable asset base, and at the same time financing the leveraged buyouts of cognitive labor business at roughly 13x earnings. And this is lent against on nothing more tangible than billable hours. These are not the same trade riding a shared upside. Now, they're essentially the opposite legs of the same disruption. One loan underwrites the machine, and the other underwrites the worker that the machine is meant to replace. And both can sit on the same balance sheet, match against 10 to 30-year annuity liabilities. That asymmetry is where any future stress concentrates. The roll-up debt is uncollateralized cash flow lending, levered at around 4x against labor-intensive earning stream. And more importantly, it is priced as though the stream is durable. If automation compresses the pyramid faster than the platforms can re-rate towards software-like margins, the advisory entity's EBITDA, the very collateral, thins while the leverage stays fixed. There are three things to watch out from here. First and foremost, disclosure on where the debt is being sourced from. Secondly, the concentration, how much roll-up paper accumulates on a small number of insurance-affiliated credit platforms. And thirdly, the supply, whether the named holdouts would come to market and at what multiple now that 2.1x revenue is the established rent. The consolidation story is well understood. The financing story, which holds the cash flow risk on the business that AI is repricing, is the one that is still being written. That's all that we wanted to share with you in this video. Hope you've enjoyed the video. Stay tuned and for the next one.